crucial, overlooked, costly. Your credit score is more than just a number. It's your ticket to financial freedom. And what's the one mistake you might be making right now that's silently destroying your credit score? So let's watch the top 10 mistakes killing your credit score and how to avoid them. But before that, don't forget to like this video and subscribe to our channel to watch more videos like this. Number 10. Missing payments, the silent credit killer. Could one missed payment ruin years of good credit history? Sadly, yes. Payment history is the single biggest factor influencing your credit score, accounting for about 35% of it. When you miss a payment, even just one, it is reported to credit bureaus and can stay on your report for up to 7 years. This dark mark signals to lenders that you might be unreliable with debt, making it harder and more expensive to borrow money. Many people underestimate the damage caused by even a single late payment. Sometimes life gets hectic, bills get lost, or bank errors cause delays. But no matter the reason, late payments hurt your score and your financial reputation. To stop this mistake, set up automatic payments or calendar reminders so you never miss a due date again. Think of this as protecting your credit lifeline. Number 9. High credit card balances. How much is too much? Do you often max out your credit cards even if you pay them off each month? This habit might be costing you more than you realize. Credit utilization, the ratio of your credit card balances to your credit limits, plays a huge role in your score. Experts recommend keeping this ratio under 30%. When your balances creep above this threshold, it sends a warning to lenders that you might be financially stretched. Even if you pay the full balance monthly, credit scoring models often check your balance at the statement closing date, not just after you pay. This means a high balance reported once a month can drag your score down. The fix: try to pay down your balances before the statement closes or make multiple payments during the billing cycle. This keeps your utilization low and your score strong. Number 8. Closing old credit cards. More harm than good. You might think closing an old credit card is a great way to simplify your finances, but it can unexpectedly damage your credit score. Why? Because the length of your credit history contributes about 15% to your credit score. Older accounts show lenders you have a long track record managing credit responsibly. When you close an old card, you shorten your average account age and reduce your total available credit. This can raise your credit utilization ratio and lower your score. Instead of closing old cards, consider keeping them open and occasionally using them for small purchases. Pay them off immediately to avoid interest, but maintain the benefits of a long credit history. Number 7. Applying for multiple credit cards or loans too quickly. Have you ever applied for several credit cards or loans within a short time? If so, that might be hurting your score. Each time you apply for credit, lenders perform a hard inquiry on your report. Multiple hard inquiries in a short span can signal financial trouble or desperation, causing lenders to view you as risky. Hard inquiries typically lower your score by a few points, but many inquiries stacked together can have a bigger impact. This is especially damaging if you're shopping for new credit to consolidate debt or make a big purchase. The best way to avoid this trap is to plan your credit applications carefully and space them out over time. Only apply for new credit when necessary. Number 6. Ignoring your credit report and possible errors. Did you know your credit report can contain mistakes that drag down your score? Incorrect account balances, wrongly reported late payments, or accounts that don't belong to you are common errors. Unfortunately, many people don't check their reports regularly and miss the chance to dispute these inaccuracies. Credit bureaus are required to investigate errors once you report them. Fixing mistakes can quickly improve your credit score, sometimes by dozens of points. Make it a habit to review your credit report at least once a year or more often if you're working on rebuilding your credit. You can get a free copy from each of the 3 major bureaus annually through annualcreditreport.com. Number 5. Carrying high balances even when paying on time. Have you ever wondered why your credit score doesn't improve even though you pay your credit card bill in full every month? The problem might be your high monthly balance. Credit scoring models look at your statement balance, not just whether you pay it off on time. If you regularly have high balances reported, your utilization ratio spikes temporarily, causing your score to dip. This effect can linger even if you pay your bill in full by the due date. To fix this, consider making payments before the statement closing date to lower the balance that gets reported. This simple step can help keep your utilization low and your credit score healthy. Remember, credit scoring isn't just about paying on time, but also about showing lenders you don't rely too heavily on your available credit. Managing your reported balances is a powerful way to demonstrate financial responsibility. Number 4. Co-signing loans without fully understanding the risk. Helping out a friend or family member by co-signing a loan can seem like a generous move. But did you know that if they miss a payment, your credit score will take the hit? Co-signing means you're legally responsible for the debt, so any late payments or defaults will appear on your credit report. Additionally, co-signed loans add to your total debt, affecting your debt-to-income ratio and credit utilization. This can reduce your chances of qualifying for your own loans or credit cards in the future. Before agreeing to co-sign, make sure you can cover the payments if necessary and fully understand the risks involved. It's important to have a clear repayment plan with the borrower and monitor the loan's status regularly to avoid surprises. Co-signing is not just a favor, it's a financial commitment that could impact your credit for years. Number 3. Having a limited credit mix. Does your credit report only show credit cards or maybe just one type of loan? While it's good to manage credit responsibly, having a limited credit mix can hold your score back. Credit scoring models like to see that you can handle different types of credit, including revolving accounts like credit cards and installment loans such as car loans or mortgages. If your credit file is thin or lacks variety, lenders might not get a complete picture of your creditworthiness. Over time, responsibly adding a new type of credit can boost your score by demonstrating your ability to manage multiple kinds of debt. Just be sure not to take on credit you don't need. Number 2. Not using credit enough or using it poorly. You might think avoiding credit altogether keeps you safe, but no credit activity means no credit history. Without a credit history, you won't have a credit score, which makes it difficult to qualify for loans or even rent an apartment. On the flip side, misusing credit, like maxing out cards or missing payments, can quickly damage your score. The key is responsible credit use. Spend within your means, pay your bills on time, and keep balances low. Regularly using a credit card for small purchases and paying it off monthly builds a positive credit history that works in your favor. Number 1. Believe in common credit score myths. Have you ever avoided checking your credit report because you think it will lower your score? Or maybe you believe that your income affects your credit score directly? These are some of the many myths that confuse people and stop them from managing their credit well. Checking your own credit report is a soft inquiry and does not hurt your score. Your income does not affect your credit score directly, it's your borrowing and repayment habits that matter most. Understanding the facts about credit scoring helps you avoid unnecessary worries and focus on the actions that truly improve your score. So which of these credit-killing mistakes surprise you the most? Whether it's forgetting to check your credit report or misunderstanding credit utilization, awareness is the first step toward improvement. Let us know in the comments how you're planning to protect or boost your credit score moving forward. Don't forget to like, share, and subscribe for more financial wisdom and actionable tips. Thanks for watching. Stay savvy, stay proactive, and take control of your financial journey.